I'm Eddie Cannell.
And I'm Tom Cannell.
We're the Mortgage Brothers team, everyone, and this is our podcast, episode 14.
14! Holy buckets.
And I have a haircut, so those of you watching on YouTube, it's feeling really good.
Feeling good, and I need to get one.
So, what are we talking about today?
All right, so I woke up this morning, and I had to hit the delay button on my alarm clock, and I'm thinking, what do we talk about today? Delayed financing. And as you know, Ed, you and I were preparing for this. It's one of those pieces, not incredibly exciting, but it can apply to you. And we thought it was important to say this earlier on in our podcast series than later on, because recently we've actually had a couple of borrowers that have fallen into each of these categories. And you know, we're talking about delayed financing, but we're going to be really talking about two different little pieces of them. The first, you know, the most important one is the actual defined term delayed financing. There's a technical term out there as to what that means. There's a second one that's kind of a, not a stepchild, but a kind of an alternate that we'll talk about later. But Ed, just to kind of quickly run through and tell the audience about what delayed financing is, what in the world is delayed financing? What are you talking about when someone says, yeah, I got delayed financing?
Right, delayed financing. What is that? Okay, if you were to ask an underwriter, what's delayed financing? They would know the answer. They would say, well, if it's certain people are eligible, certain borrowers are eligible to take a cash out of their home purchase if they've recently purchased it with cash. Okay, so if
can't you do a cash out anyway?
No, so that's where this rule comes in. It's all about the cash out. Okay, delayed financing is all about cash out. It's someone you want to. Delayed financing is all about taking the money out of their home after you've purchased it with cash.
Right, but what about the seasoning? The biggest part is
6 months. If you buy a house typically with cash, you cannot access the cash out until 6 months have passed.
So you buy the house, you cannot access your cash no matter what for 6 months.
That's right, unless you qualify for the delayed financing rules.
Aha.
Yeah. So it's 6 months is the seasoning rule. So let's just say, what are we going to talk about? I think just to make sure the audience, we follow good here. We have, some people call us and they plan for the delayed financing, right? Sometimes they'll call, Eddie, I'm going to buy a house with cash. I want to take cash out. Now, a borrower who calls and plans ahead of time, we can carefully orchestrate how this works.
Mm-hmm.
But a lot of times borrowers call us and they said, I just bought a house with cash and now I want to take the cash out. And in most cases, it doesn't work too well if they haven't planned.
Right.
So maybe that takes us to the next point we want to make. I mean, maybe first, do you think we should talk about, why would someone ever do delayed financing?
Yeah,
why delayed financing?
Yeah, and why don't maybe you just give an example of a borrower that we've had recently where the delayed financing piece comes into play?
Okay,
because I think that one was accidental, wasn't it?
Well, let's see. I had one borrower who did buy a home, and they wanted to get a deal on it, and the seller gave them a much better deal because they came in with cash and closed in 7 days or something like that. So they didn't want to use financing. They want to purchase the house. They just wanted to buy it, get a good deal. They probably got $15,000 lower than someone else would have with financing.
Were they planning on doing an immediate cash out?
No,
they thought about it.
No, that borrower did not. And actually, most people aren't thinking it. They're actually thinking they can buy with cash, call up a lender, and take cash out. Most people assume you can just take it out.
You can just do it right
away. So I told her, under normal circumstances, you'd have to wait 6 months. So I started asking the borrower where they got the funds. The important thing about delayed financing for this borrower, is that we had to be able to source where she took the money. It had to be her money. Okay. Delayed financing we have to prove that you use your money and your investment accounts, a home equity line of credit. It could, even if it's a retirement, even if you took a 401k loan.
What happens if it's from a business account that you own?
That a business account could work. Is that right? I haven't had that come up, but.
Yeah, and I think one of the items we had come up was it came down to what percentage of ownership they had in that business.
Okay.
And as long as they owned the business, I don't know if it was I think it was 100%. Maybe they could have been a majority share, but I believe that was in your scenario. And so documentation had to be pulled, and it was confirmed that it was his business that he owned, and so they could treat it as his cash versus a business that he's a small partner in giving him the cash. I mean, it has to be your money. It has to be sourced.
Yeah, it has to be your money.
Your money is the point. Okay.
Yeah. And where people get into trouble is when they got a gift or a loan from somebody. They got an inheritance. They exchanged. Let's just say that they traded something in, like it was a vehicle, or Uncle Joey gave them something. But again, I think anyone who comes into money, if it came from someone else, that won't work.
Okay, so if
all the money back, it will probably, usually is an issue. We want to see it seasoned in their,
right,
their money.
So if you buy a house for cash for $200,000, 100 of it came from some random gift. The other came from sourced money of yours. You could still do delayed financing, right?
Yeah, if you've used $100,000 of your own funds, you can take a cash out refinance and take out the 100 that you put in.
The 100 you put in, okay.
Yeah, no more. Yeah.
Now, if for some reason you want to take out all of it, you could also just wait the 6 months.
Yes, you could do that.
So for our listeners to know, these things do get very, very technical. This is really only for the person that is wanting to do a cash out, may know about the seasoning requirement, may not. Regardless, we have a way to be able to help you do a cash out refinance sooner than the seasoning requirements. Again, whether you knew it or not, if the money can be sourced, and if you use your own funds.
Yeah. So, and I'm going to end it with this. These, again, the lenders price these loans as cash out refinances. The loan to values are 80% of the appraised value, and you get the interest rates right from based on the cash out. So that maybe leads us to the next the alternate delayed financing.
The alternate. So we called the first one the big DNF, which is the defined term delayed financing. Now we call this the small D and the small F.
That's right.
This is an alternate financing that I did. It's probably been a few months now. But basically, I got a call from a borrower, and the borrower said, we've been losing homes to cash buyers. And we got so sick of it, we decided to call my dad and have him buy the house for us. But we want to make sure that we can actually refinance him out after we're done. And I made a couple of calls and looked into it and said, absolutely, we can do that. So the small D and the small F delayed financing is when this borrower was intending to put financing on, but didn't want to lose a deal by having a financing contingency on her offer. So her father paid cash, and then she went in and she did a rate and term right after she closed the deal to pay her father back. And
so this alternate delayed financing is really, when it's all boiled down, a rate and term refinance.
That's all it is.
The dad bought the house, but he technically didn't buy it. He was the lender on it. He gave her the money.
And talk about, what does it mean to be a lender on it? What would he have to do to her or for her in order to allow her to refinance him out?
And the title company created a deed of trust, recorded that. It's an official document. So when we do our loan, all we're doing is paying back his loan that he gave to his daughter, and it's a rate and term refinance. And rate and term refinances can go up to 95% loan to value.
Perfect. And that loan has to look and feel like a real loan.
Yep. It has terms.
Can't have discounted interest rate, can't be free, can't be payment free. I mean, it has to literally feel like a real loan so that when we do our rate and term refi, we're actually refinancing another lender. We're not refinancing dad, so to speak, even though we are kind of.
So this alternate delayed financing actually is a better alternative. And, if you were like to really prepare, so if people have questions on it, definitely let us know. It's an awesome way. The pricing's a little bit better. You can go higher on the loan to value, but you do need to create that deed of trust. And basically there's a lender right on that loan.
Awesome.
On the home. So I think we would say is that we have obviously the delayed financing that's in the official, right? What do we call it? That
we're going to call that the no seasoning cash out refinance.
There you go.
Delayed financing. That's all it is. You're just getting around the 6-month seasoning for a cash out. That's the technical delayed financing.
Okay. And then number 2 is just the alternate, basically a rate and term refinancing the deed of trust.
That's right. Getting a little bit creative with dad, your aunt, your uncle. Not super common, but it happens. And when it works out, people just love it.
Yeah.
So, okay. Anything else from like title? If people say, well, who in the world can draw title or, loan docs? The title companies.
The title companies will be helpful.
Yeah.
And when we do a rate and term refinance, when you go through like the Mortgage Brothers, one of our title companies that we work with a lot will help you through all that.
Yeah.
Getting the deed of trust. There will be a note. There'll be a note between you and whoever it is giving you the money, and the title company will help you with the deed of trust. So we'll guide you through all that.
Yeah. Awesome. Well, we're probably forgetting something, but I think we covered most of it.
Yeah, I think high level. I think it makes sense. And if anyone has questions on it, let us know. And I think we're done.
All right, let's call it a day.
All right, time to go home.
All right,
everyone. Hey guys, thanks for listening to the Mortgage Brothers Show. Please let us know if you have any questions you'd like us to answer on this podcast. You can email your questions to Tom at azmortgagebrothers.com or yours truly at Eddie at azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. Tom and I will personally work with you and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisor before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.